All right, everybody, welcome to our webinar today. I'm super excited because this is a topic where we talk about benefits, and we're in the 401k space. A lot of times we don't get too involved with the health insurance, but there's some things coming up next year, and I'm really excited to talk about this today. And we have a great guest, Steve Watson. Now, Steve is just one of the most incredible presenters, but also he understands the health insurance world better than anyone I've ever talked to. And he's currently a CFO and a CHRO, so he knows his stuff. He's actually practicing for his company to manage their healthcare. And today we're going to kind of dive into a topic that I think will be really on the radar coming up early next year as we start to see more transparency. So all of us in the 401k space, you've seen our fee disclosures. We've had rules and regulations around clarity on what we get paid. Health insurance brokers have not until now. And so this is a topic I think you'll really benefit from learning from. And Steve is one of the experts about it. So I'm going to head to Steve. Appreciate Steve today. And we're going to kind of listen in and have him teach us.
I appreciate it, Jake. And glad to be here to talk about this. And it's one area that people in the employee benefit space, this kind of got thrown at them last minute. And so they're all trying to learn as well. And so it's an area, if you are a broker right now or prospect, it's a way to kind of get out in front of this and kind of be the first one out there talking to employers, because most employers haven't heard about this as well. The brokers are kind of left scrambling. But let's kind of dive into this. Let me get my PowerPoint up here. All right, so we're going to talk about the new fee disclosures for health plan consultants here. And so a little bit about me is, like Jake was saying, I am a practicing CFO, CHRO. So I work for a company that has about 500 employees in the state of Arizona. And those two hats are a little bit different, right? Because most CFOs are in HR or vice versa. So what the story around that, just kind of quickly, is I was a CFO at the company. About a year into my tenure, the HR director quit, looked at me and they said, HR, finance, it's about the same thing. We'll just give it to you. And, I don't know in what world those are the same, but, I'm somebody that I like to dive into things. And so I went and got certified in HR. I've really worn those two hats for the last 10, 12 years. And one of the big areas that I find that they cross over the most is employee benefits, because you got to have benefits to recruit and retain employees. That's why we have them. But then they're like the second or third largest item for companies to pay for. So financially, it's a big thing. So quick little thing here. Do you know that Starbucks actually pays more in health insurance than they do on coffee beans? So just kind of let that sink in a little bit. How big an item this is for most companies. And what I found is that a lot of people like me just don't know a lot about this area, CFOs and HR professionals out there. So I founded a group called Trend Breakers to bring employers together to share ways to break the rising trend of healthcare costs. And I also host, 3 different podcasts. So you can go subscribe. Had Jake on the Trend Breakers podcast. It's really focused on helping employers break the rising trend of healthcare. And then I also do a couple interviews, one's a CFO interviewing CFOs and then interviewing HR professionals on their journey there. So you can look up those podcasts. Let's jump into today's topic. And so again, most of you, you're very familiar with the 401k space and the fiduciary responsibilities around that, especially from the plan sponsor. So when I meet with my advisors, when I meet for people in 401k, one of the things, I don't want to end up in court. I want to make sure that we're doing our due diligence, we're doing our RFPs, we're looking at all the fees and doing all that stuff within there. The ironic thing is that as an employer, as a CFO, we don't usually do that level with employee benefits. And it can vary a lot, the size of company and different things. And so just think about a company my size, about 500 employees. Most CFOs and HR professionals at my size don't even know how much the broker makes. They don't know all the different things involved with it. There's just this kind of black haze around how things work. But yet I've had this fiduciary responsibility I just didn't really know about. And that's all changing because of new laws that are been coming out. So at the end of 2020, there was the Consolidated Appropriations Act. So and when President Trump was ending his term, there was that big $2.3 trillion spending bill that was going through the process. It got passed on 12/27, so right after Christmas. And it has a lot of stuff about PPP loans, money out there helping, kind of like 2,000-page bill out there. But tucked into that bill, there was a couple big things for this space of employee benefits. One is around medical surprise billing, and there's a whole other webinar, a whole other podcast just about medical surprise billing and transparency requirements for hospitals, for medical providers, and different things. Much needed. All of us, we show up at the doctor, we really don't know how much that bill is going to cost and stuff like that. But again, that's a whole other thing. But tucked into this law on 1713 was a section called, this section 202. It's disclosure of direct and indirect compensation for brokers and consultants. And this has been on the table for the last 3-5 years. There's always been a lot of pushback from big brokerage firms, big publicly traded firms on not having this in there. And the ironic part about it is nobody really knows how this got in there. Whether it was like a committee member mistake or somebody just tucked it in there and then they forgot to pull it out, but it got signed. It got put in there. These disclosures, and it kind of caught the industry off guard. Like they weren't ready for this, they weren't expecting this, and all of a sudden it became law. So what, at a very high level, I'm a lawyer, so you can go read the law yourself, you can go get your lawyer stuff, but at a very high level, what does this say? It's plan sponsors, aka me, employers, are responsible to know all the direct and indirect compensation above $1,000 being received by cover service providers. Again, this is very new. I mean, a lot of people in my space, I'll ask HR professionals out there, like, how much does your broker make? Like, I don't know, the insurance company pays them, like, whatever, I don't know. But now you are required to know. And it's more than just the broker. Knowing how much the broker makes, down here below, TPAs, the PBMs, group purchasing organizations, medical management providers, stop loss, wellness. Who is making money off of your company and how much are they making? Who's paying who? Just became law that I, as a plan sponsor, need to know those amounts. So the ultimate responsibility, when I first heard this law, I was like, that's actually a really good thing. It'd be nice for these people to, disclose their compensation to me, great, whatever. The piece that caught me off guard personally was this part in yellow that, this is a quote from these lawyers out there, but it says, similar to service provider disclosure rules in 401k, profit sharing, pension, whatever. It says, if such disclosure does not satisfy these requirements, aka you didn't get them or whatever, the compensation paid to the service provider will be by definition unreasonable. So all you 401k people, just let that kind of sink in a little. So if I, as a CFO, I work with somebody that I don't even know how much they're getting paid, automatically the Department of Labor is going to classify that as unreasonable. And according, the payment of the compensation service provider will result per se in prohibited transaction. And it's on me. I'm the one to get in trouble. And they talk about, the ability to pierce the corporate veil and, file a lawsuit against me that I'm not, keeping my fiduciary responsibilities under ERISA. So it's a big deal for CFOs and HR professionals now to make sure that they're getting this disclosures, this compensation requirements, and this is information that we haven't had in the past. And again, it's just rolling out right now. You're starting to hear buzzes around it. You're starting to hear buzzes in like the broker world and stuff about this. It hasn't hit my world yet. Again, it's new, stuff like that. But when I talk to other CFOs, they're like, I haven't heard about this. HR professionals haven't heard about this. So this is something that, with your clients, if you're an advisor, it's something to share with them. If you're an employer, it's something for you to get more information about. And a lot of it is, some people will say, well, I kind of already know the compensation, or I kind of know stuff like this. This is something I've been working on the last few years of trying to find out all the different ways that a broker gets paid. And again, as a buyer, as a CFO, as an HR professional, I kind of knew about one, which is this first one about medical commissions. I remember I got a 30% rate increase one year, and I remember looking at my broker across the table and just thinking, it's like, wow, I'm getting a big rate increase, but my broker is getting ready to have a 30% raise. That's just not right. It's, I had in my head that they were getting paid, and so we started to negotiate this stuff here. What I didn't realize until I became a fractional CFO and started working for an employee benefits brokerage agency as a CFO, working on their budgets and different things, about all these other things that are inside of their compensation. And this is the area, these other 4 areas is what brokers are really worried about right now, about how to disclose this stuff, how to work on this. And so let's talk about them. So again, if you're an employer, it's important to understand how the past has been working, how much they have been getting paid. So as you start to look forward and start negotiating rates, you'll be aware of these things. So let's talk about it. So the first one, medical commission. Usually insurance carriers will pay either per member per month fee. Usually if they're up to 50 employees or 100 employees, there's a set amount per employee that they'll pay, or they'll pay a percentage. It could be 5%, 3%, 4% of the total premiums paid out. Again, when I say broker compensation, this goes to the agency, and then that individual broker probably gets 20 to 30% of that total thing. That's how that individual gets paid there. That's the medical commissions. But the second one is called medical overrides. So how this works is if you're working with Blue Cross and Blue Shield or Aetna, it doesn't really matter. They all do this stuff. But if you have a big enough book of business with, let's say, Aetna, you get over a certain threshold, they may be paying you 5% right now on all your commissions there. But if you get over a certain threshold, they throw on another 1 to 2%. So sometimes the bigger you get, the higher those overrides get. And it's these overrides that have never shown up, usually are not disclosed to employers. They would argue, for me on a 5,500, these medical commissions would show up there, but these overrides wouldn't, and brokers would argue that, well, it's more general, it's my whole agency, my book of business, it's not specific to that company. So there's a lot of money flowing through on these overrides that employers were never aware of. A third one is bonuses. And so I actually became a licensed broker just so I could peek behind the veil to see what things were going on. I started getting all these flyers from Blue Cross saying, sell this amount of business, we'll give you an extra 20,000. Sell this one, we'll give you an extra, so many per employees. There's a lot of bonuses, either for new business or for retention bonuses for keeping there, that employers aren't aware of as well. And it was always something frustrating. This was another area I was frustrated as an employer to learn about is, I may have 4 or 5 plans that broker's presenting to me, and to realize that maybe 2 of those plans there might be a bonus tied to it, and these other 3 plans there's not a bonus to it. And so is the broker pushing these plans for me to sign because it's good for them or good for me? And so that's just an area that, again, they'll have to start disclosing. The fourth and fifth areas, ancillary commissions and overrides, again, is another area that I wasn't aware of, but it's all of the compensation tied to non-medical things. And so think about a company, there's the medical benefits, but then there's a whole bunch of other things that we have for benefits. There's the dental plan, the life insurance plan, the short-term disability plan, all of these other kind of ancillary lines. There are 10, 15% commissions tied into those ones. And there's also overrides as they get bigger and bigger and sell more. There's money baked into those things. And so as much as a CFO might be negotiating the medical commissions piece of it, I've seen brokers that lower this down so they can close the business, and then they don't disclose this ancillary money, and they're making more money over the ancillary lines than they are on the medical commissions. Well, again, that all ends starting next year as far as having to disclose all of it. And then the last one, again, there's many other areas, kind of smaller ones, but in the last area, and this is kind of what ties into this new law, is these revenue sharing agreements. So there might be a broker that brings in a PBM, a pharmacy solution there, and there was one here in the Valley in Arizona that they were getting, every time a script was written, that broker would get $1 or 50 cents or something. They were making money off of the solutions they were bringing in, either the payroll system they were bringing in, the TPA they brought in, or different things they were paying to these areas. Again, now all of this has to be disclosed. So I just want you to let that sink in. I'm going to tell you a little story to make this kind of more relevant and stuff. So there's a school district in Texas that I was talking to an advisor that lives in that area. This school district is huge. They had 3,000 employees. I think they were spending around $30 million on medical commissions, and they went up for a big RFP. So one of the big firms went and bid on this stuff like that, and one firm bid $60,000 in compensation. $60,000. I mean, it's a lot of money, but $60,000 spread across 3,000 employees, across $30 million stuff is peanuts. It's just so small. I mean, we're talking to my one advisor. He's like, man, I wouldn't even get out of bed to get $60,000 to go work with that big of a company. But this company, the school district, was adamant, went before their school board, everything, saying it's $60,000. This is what's in there. It's signed in there. This is what's disclosed in there. It's only $60,000. Well, let's kind of think about these other areas. Medical overrides. If you get 1% of $30 million, that's That's $300,000, just that 1% here. If it's up to 2%, which is probably where they're getting close to, you're getting up to $600,000, almost 10 times the amount of compensation that they could be getting through medical overrides versus their medical commissions. And so as that school district for the last few years thinks that they're only paying $60,000, they're not aware of all this other compensation that now all of a sudden this broker firm is going to have to disclose that. How do you think that conversation is going to go this year? I mean, just let that sink in. And that's not including the bonuses, ancillary, all these different things. So there are big kind of conversations happening this year. I think it's going to shake up the industry this year, or they're just going to eat it. This company's going to say, well, we said $60,000. We're not willing to disclose this information, so we're just going to eat it for them. And so they're not going to, how's their service levels going to work with that company or that school district, or they're going to have to renegotiate these rates or whatever. So again, for the next 9 months, there's going to be a lot of discussions out there with brokers and stuff about compensation. So you might be wondering, so what is a good rate? So if we haven't known about rates or different things, what is a typical rate you should be looking for? And as I've worked with many different companies, as I've looked at 5500s and kind of met with industry, I've seen the market rate for broker agencies land between about $25 to $35 per employee on the medical plan per month. So you can just do all the math there. So you got 100 employees, about 25, take it times 25 or $35 per month. That's how much that firm is getting on your plan. So if they come out and you think that they've only been getting $5 per employee per month, you're probably not seeing all the compensation, or at least you haven't been seeing it in the past. And I've seen other plans get up around $50 to $70. There was a nonprofit organization here in Arizona. If I told you their name, everybody would recognize their name. But they were, up around $80, $90, and they were just getting ripped off, frankly, on how much they were paying for it. But this is usually the typical size. I've been paying $25, my plan, for the last 8 years. And so about $17 has been on the medical side, about $8 for the ancillary lines, around, $25 even is what I'm paying for a company with 500 employees. So the bigger you get, this should be going down too. I mean, size matters up to a point, and then all of a sudden, between 500 employees and 750 employees and 1,000 employees and up, that scale, it should be going down. So what do I recommend companies do right now? So I call it a stewardship review. I love this term around stewardship. You think about the old, castles in England and stuff like that, where they had stewards. The kings would appoint stewards to them to look over their lots and different things. And so they had the responsibility and the fiduciary responsibility over that area. So I highly recommend employers do a stewardship review with their brokers right now in the spring, before all of this works, is to do a stewardship review with them. What does that mean? Is just pull out a piece of paper. It doesn't have to be fancy. You could just email your advisor right now and say, on one side, I want you to list out all the services that you provide. This is a time for you to shine. I do this quote, I talk to this many people, I do all these things. These are the things you've asked me to do. Here's the other things I provide that you haven't asked me to do. Let's just all list them out here, services provided. And then on the other side, I want them to list out all the fees they've collected and trend it for the last 2 or 3 years. So I want to see the medical commissions, the bonuses, the override, all these different things. And frankly, this was an area that was hard to get people to share in the past, which now by law, starting in 2022 and forward, they have to disclose to you up front. And that's kind of, and I didn't talk about this when I talked about the law. This all kicks off in January of 2022 for new plans renewing then. They're supposed to tell you before you sign on the dotted line, before that plan kicks off, how much money they're going to make off of bonuses, overrides, all these different things. So write down all the services provided, write down all the fees collected, and hopefully you're both smiling. That's what capitalism should be, is when we're handing our money over to somebody, they're giving us a product or a service, we're both happy about that transaction. I know what's going to happen again this year is that you're going to have a bunch of people that they're providing lots of services, but they were indirectly saying they were only getting paid X and they were really getting paid Y. And people might have been smiling around the part X, but now that they see the other Y, like that school district, We'll see. We'll see how this plays out. I mean, Jake and all you folks that have been in the 401k industry, you guys saw this happen 10, 20 years ago when it rolled out in the 401k area and how that changed that industry. I'm expecting that sort of thing to happen in the employee benefit space over the next few years. So as far as questions, I'd love to kind of answer any of your questions. I was trying to kind of keep this high level and stuff, but just show you some of the things that are coming down the pipe. I'm happy to go into different areas there. So I don't know, Jake, if you got any questions there, anybody on the chat?
Yeah. Yep. Sal asked a quick question earlier. He said, does this affect brokers who sell supplemental insurance? I think he means like other ancillary insurance. Does this apply just to employer benefits?
So it's mainly on the ERISA plan. So it'd be, health, dental, long-term disability. So some of those worksite benefits, it doesn't affect them. However, most of those benefits get sold to the company by these big brokers that do the medical side. So if you're going to disclose 95% of your commissions, if they don't disclose that other 5%, I think they're setting themselves up to fail. And so my guess is most of them are going to start disclosing all of it. So if you are if all you do is sell these supplemental benefits, then no. But if you're partnering up with another broker, then yeah, you're going to have your compensation disclosed.
Nice. Yeah. So, and those are some really good points, I think, is to be proactive. As we all know, in the benefit space, it gets really busy in the fourth quarter. Renewals start to happen. Most companies I find are on like a calendar year. And so this is really going to, I think, be a disruptor. And so as an employer, even just being really on top of things and asking. So, because I don't think brokers are going to be the ones that are going to be loud about it, right? Unless they're trying to chase a new plan. I'm trying to think.
I think the ones chasing new plans are going to be super loud about it. And those ones that have been getting compensation that they didn't share are going to be pretty sheepish about it, right? And so I could see them, again, they might have got paid these bonuses in the past. I could see them not getting them in the future just because they don't want to talk about them, or those revenue sharing things. Maybe they're not willing to share those things. But that's a huge hit compensation-wise. Like one of the things I'm going to work on this afternoon to go look up some of these publicly traded brokerage firms and see in their guidance that they give out to shareholders, what are they saying about this? Because there's a huge risk for them.
Yeah, absolutely. Another question: are both the carriers, healthcare providers, and or payers of healthcare compensation also responsible, along with the benefit advisors and consultants, for disclosure of this? So I think he means it like as far as like the carriers. I mean, they have to disclose things as well, right? Is that the same rule that we're talking all in one? Everybody has to disclose everything.
Yeah, so it's the ones that you have a direct contract with are supposed to disclose who they are receiving compensation from. It's not who they're paying compensation to, right? So you insurance carriers, yes, they would have to disclose this stuff, but they're supposed to be, if they're receiving stuff from them, they would have to disclose, but usually they're the ones out paying, right? They're the ones paying the brokers, they're the ones paying these different things. So does that make sense? Yeah. So if somebody's receiving compensation because of something tied to your plan, they are required, anything over $1,000 required to pay for it. That could include trips. It can include those vacations to Cancun and different things like, Super Bowl tickets or something like anything over $1,000, they are supposed to disclose to you.
Yeah, I know that's a huge deal, or it was before COVID, where, in the spring, a lot of brokers would be going on these big trips. I actually had a client that put those trips together. And so I heard all about them. And I always found that strange that brokers would want to go. I mean, they would sell, one product, kind of bounce around product to product because of the different trips they would do as incentive.
And that ticks me off as an employer. I'm like, seriously? Because again, when they come to, and this is my pet peeve, it's not about the money that they're making. There's definitely a few of them that are making way too much money. It's the alignment with them. And so the example I use, I don't really care how much a pharmaceutical sales rep makes or the trips they go on or whatever. They're representing that company. They're selling products for that company. Where it starts to matter for me is if my doctor is prescribing that prescription or that script because a trip or a fee or different things, because that doctor's supposed to be on my side of the table, right? They're the ones helping me navigate this world. And so when brokers come and meet with me as a CFO, that's what they're presenting. I'm the doctor. I'm not biased. I work for you. I'm not tied into these carriers or different things. But you start diving into the compensation, there is a lot of biases built in. There is a lot of bonuses and things built in there. And so they've kind of played both sides of that it's going to hopefully end here in the next few years. And so that alignment matters to me. Is I want brokers that represent me, that I discuss the compensation with, that I set the compensation with, and they work on my side of the table.
Yeah, it's interesting. It kind of makes me think about the separation of the size of the employer group, right? I think we find in the 401k world that the larger the group, the more likely you hit a certain level of enterprise, massive companies. It is more that consulting arrangement. It's a flat fee. Where we lost Steve. There you are. Where the middle area where it kind of gets a little bit gray. There's some compensation being paid from the funds, as well as like an annual fee. I mean, there's all sorts of fees that get tied into that. Do you think in the benefits world, as far as health insurance, that this rule will eventually get everybody to that same, where everyone just says, we're a consultant, we charge this amount, and every year we kind of raise it a little bit based on inflation?
I hope so. Yeah, I really do. I really think that's where it's moving to. And some of the brokers have been out there touting this as their competitive advantage, that they were the ones being transparent. They're the one. Now they're going to lose it because everybody has to be transparent with it. But you bring up a point that size does matter with companies. And so if you're working with a company that has less than 50 employees, less than 100 employees, this probably isn't going to be that big of a shock. I mean, think about a 401k plan. If you're only working with a company with 3 employees, the amount of money you're making is very, very little, right? Because of how big they are. And so an employer may look at, oh, you're only making $500 or $1,000, whatever. That's small. Where I see the biggest hit is going to be with companies between about 100 employees to 1,000 employees, because a lot of times they're on these like kind of small group compensation arrangements where it's this 5%, these bonuses and these overrides. And companies don't realize that they can negotiate the fees down once they get over those thresholds, almost like 401k. Once you get over $1 million in assets and $10 million in assets, those record-keeping fees and everything come down. Well, employee benefit stuff, it comes down as well. It's just employers aren't aware of that it can come down. And so brokers tend to milk those compensation arrangements. And yeah.
Right.
You're seeing my biases come out.
Yeah, no, but it's good. The other thing, I know there's a lot of employers out there that are kind of either in a PEO relationship or kind of a pooled plan relationship. What do you think how's that going to look in those situations where it might be not as easy for the broker to show that transparent? Yeah, maybe it has to be. I don't know. They're going to
have to. Again, it's on. Again, as the plan sponsor, I'm responsible to know the fees that are getting paid on behalf of my company. And so those arrangements and different things are going to have to figure a way to allocate those fees and split them out between those different companies so those plan sponsors are aware of it. But again, I don't think anybody was ready for this. And so they're all trying to figure it. So I attend a lot of broker things. I'm hearing talking about, like, this is all new. They're like, how are we going to split this out? Well, you're going to have to figure it out. I don't know.
And that's I think the key point to make is that this doesn't really fall on the shoulders of the broker. It falls on the shoulders of the employer, right?
Yeah, and that's what I was surprised, because I thought it fell on now it falls on their shoulders to disclose it, but they're not the ones that get fined. They're not the ones the Department of Labor doesn't go after them. They go after me, which is like, I'm the one that's supposed to be getting this information. That's why I think it heightens the level why this is going to get implemented, because HR is stickler compliance, right? So you get these HR people, you find out they have a potential for liability. It's going to be like 401k plans. They're going to make sure it happens. And I think you're going to you'll probably see companies that are probably that aren't too proactive about this. And I think you're going to see a lot of other brokers trying to land new prospects using this information. So it's going to spread pretty quickly of like, well, that other broker's not telling you, well, this is the law, and come work with me because I'm going to show you all this.
Yeah, I think there's going to be a ton of webinars and a lot of different presentations out there.
You tell me, how did this work in the 401k space 10, 15 years ago? I mean, when you have all these commission-based stuff, and then it became, it probably took a while, but.
It does. Even now, looking at disclosures that we're required to have, depending on the record keeper, sometimes it's even difficult for me as an advisor, 15 years, to really get through what they are actually paying, right?
And so other ones are getting sued, right? There's still companies because they're not, their fees are too high, they're not doing their RFPs so they're ending up in court. It wasn't like big universities ending up in court because they're not doing their due diligence. So yeah, we'll see. It'll
take some time, but I think you're totally right. It's going to be a pretty hot topic going into the end of the year. We're going to hear a lot more about it. So I just wanted to make sure everyone was aware, so that you could be proactive with your own relationships, because it is important that your broker or your consultant is just like in the 401k space, they should be working for you, right? And that's the whole, I think, end goal of this is they need to understand your company and be on your side and fight for the best thing for you. And if they're getting paid and have a conflict of interest, then that needs to come out. So in the end, we all want the same thing as far as everybody, everyone has to make money. Everyone's working hard to get the benefits they need. But what's fascinating to me, and we talked about this in the last show with you, the size of expense from the benefit side versus the 401k side is extremely a lot larger.
Yeah, so just an example for the CFO side, when I'm looking at my P&L and the expenses that the company's paying, 500 employees, I spend for my 401k advisor, record keeper, I don't know, you probably like throw me over the coals here, $30,000, $40,000. You tell me if that's high or low, but that's about what I pay there. Workers' comp and property and casualty, they're probably getting $40,000 to $60,000 worth of compensation. The employee benefits advisors, they're getting $140,000, and I'm on the low end for my company. But for the benefits, it's $3.4 million is what I'm paying in, healthcare insurance for my company. Okay, matching, all that stuff's probably $200,000 or $300,000. So it's 10x the amount. So it's a big number.
Which is why when we show up as 401k people, we're talking about, well, we can save you some big dollars here. It's nothing compared to what we're going to do. So that's why, if you're on this and you're not sure what to do, I mean, the first thing to do is talk to your current consultant and broker and just see what they tell you about this and just kind of get the ball rolling right now, because, as you get into the last year, it's going to be tougher to have that discussion. Well,
and it's frankly the biggest opportunity areas that companies have. There's a bunch of money baked in there that they can save, and that's the whole other webinars on how they do this. I say $500,000 on just kind of rearranging how I purchase my benefits and didn't impact the employees. The fact is, most people in HR and finance aren't aware of these things. They're not really involved in it. They just kind of trust the brokers giving them all this best information. But yet, when you look about a 401k advisor, they're very good at like having committees and looking at fees. I mean, they already know how to do that skill set. And you look at comp claims, they know how to manage claims. It's just how to get them to take those two skill sets they already have and apply them to the employee benefits world. That's where I think the power is going to come in. So if you're a 401k advisor, and if you partner up with employee benefits brokers, that's where I think there'd be some power. Like, how do you take the two sets and apply them to the different areas?
Yeah, and help. I think when you find those savings, it's going to allow the company to invest in other areas, whether that's
what I just helped a company here in Arizona. They were spending $6 million on employee benefits. They ended up saving about $500,000 last year. Well, guess where their money? They put in a 401k. So they increased the matches and different things in 401k. Because most companies, yes, they want to kind of keep it for themselves, but a lot of companies will just say, let's increase wages, let's increase benefits, let's kind of use this money in a better way instead of just giving it to insurance companies.
Right. Yeah, because then it's going back to the long version of why the 401k can be successful. Because we used to have a pension was a liability. Now it's off the books and it's a 401k, but we don't force or get people educated enough to use the 401k to be retirement ready. So if you had a team or a group of people that are ready, it's healthier for the business long term, right? It eliminates the risk of having an aging demographic needing health insurance that you're paying for.
Yeah, and frankly, it's one of the reasons health insurance is one of the reasons why companies are paying less and less to 401k pensions and stuff like that, because they keep going up. It was like 20 years ago, and a family plan was $5,000. Now most deductibles aren't even $5,000. Now an average family plan is like $20K. It's a car. We're like basically buying a car for all of our employees for those same benefits that we had 15, 20 years ago. And so it just keeps sucking more and more money out of companies. And that's why I'm excited about trying to break that trend and do stuff so we can put that money back into other areas.
Yeah, exactly. Awesome. Well, is there any other questions anyone else has? Anyone, Rand, or you can put it in the chat or the question bar. I really appreciate, Steve, you taking the time today. This is an interesting topic I think you're going to hear a lot about. And Steve is one of the best ones. So you can reach Steve. Right. He's all over social media. He's got 3 podcasts. He's got Trend Breakers, which is a consulting firm to help you if you're in charge of your own benefits and you want somebody to share this
last slide here. So it has all my contact information on it.
Yeah,
here,
perfect. So. Yeah, pull that up. Yeah, so make sure you connect with Steve and start listening into what he's doing, because he, just like a lot of brokers out there, they're there to represent and help you, but Steve's actually in your world, if you're in charge of your benefits. So let's see if there might be one more question. No, just a thank you. So,
all right. I'm happy to connect with all of you guys. So again, Steve Watson CPA, that's how you find me, because there's 100 other Steve Watsons out there. You can look up trendbreakers.com. highly recommend these podcasts. Listen to them. Really great experts on there. It's where I'm learning a lot of this information. There's one from Jen Berman, who is actually an ERISA attorney, talking about this very topic. And so it's more of a deep dive, about 40, 50 minutes about this. If you want to learn more about it, highly recommend sharing that episode with your clients as well. So.
Yeah, I've done the same. I mean, you have some great guests. It's one of my favorite podcasts. I drop it on I'm on a long drive to catch up on so many good topics that are really relevant and helpful. So yeah, definitely follow Steve and get some good information from him.
Cool. Well, thank you. Appreciate it.
Okay, thanks everybody. Have a wonderful Thursday, and we will see you soon.
Thanks.